What do California's wildfires and Japan's stock markets have in common? Well, nothing apart from the fact that both are examples of stark extremes that have taken everyone by surprise. California had been devastated by wildfires for a decade. Long term droughts had turned forests into dry tinder. So everyone was elated when in 2017 it had one of the wettest winters California had ever seen. The record rain caused even desert towns to be covered in green. But when the green turned dry, it caused wilder forest fires yet again. Similarly, it took the Japanese Nikkei 30 years to get back to the levels seen in 1991. Between 1991 and 2021, the Japanese benchmark index languished below the 1991 peak. The reason is simple to decipher. The returns in Japanese stock markets were so extreme from 1950 to 1990 that there was negligible upside left for subsequent decades. Now, why am I recounting instances of extremes in nature and stock markets? Well, because the behavior of cyclicality in nature and the stock markets are very similar. And whenever the returns are steep or valuations extreme, there is a need to be skeptical about the future. Let me tell you about one such business that was declared a failure but went on to become a multibagger. I am referring to the stock of Titan. It was in 2010 that an article in Forbes called the stock of Titan a golden cage. It speculated if the new management at Titan will be able to prove the merits of the growth plan laid by it. Mind you, the Tata Group company had always had iconic leaders. Sir Desai, the iconic leader who founded Titan in 1986, was a towering personality. He wielded tremendous influence inside and outside the company. So when Bhaskar Bhatt succeeded him as the MD in 2002, there were concerns whether he will fill in the shoes of his mentor. When Bhatt took over the company in 2002, Titan was in a very bad shape. Titan had made huge investments on a new factory to manufacture watches in 1980s. But when outsourcing began the norm, Titan wasn't quick enough to make the transition. All this while, the company had also been borrowing money to fund its internal All this while, the company had also been borrowing money to fund its international expansion. Most importantly, the board of Titan wanted to shut down Tanishq, then a loss-making brand of international jewelry exports. Tanishq's launch in India was also very jittery. The concept of branded jewelry was then ahead of its time. Indians preferred their traditional family jewelers. Habits were hard to break. Even a McKinsey study recommended the board of Titan to wind up Tanishq. Nevertheless, Tanishq was perceived as a premium brand due to its gold purity guarantee. So, Bhaskar Bhatt's endeavour to help Tanishq survive and thrive worked wonders over the past decade. By 2010, Tanishq was the largest organized jewelry retail player in India. But even with 115 stores in 75 towns, it had barely 4% of the market share. Further, the organized jewelry retailing segment was only 1/10 of the jewelry business in India then. Later, Titan installed what are called the carat meters in its Tanishq stores. This was at a time when there was growing anxiety about the purity of gold being offered by family jewelers. The instrument used X-rays to measure the purity of gold in 3 minutes. This exposed the unfair practices of family jewelers. It also gave Tanishq a big edge versus other branded gold jewelry companies. By 2020, more than a third of Titan's sourcing of gold was from the gold exchange. The management hopes to take it to 50% by 2025. So, what is it that allowed Titan to become the jewelry behemoth that it is today? The chart here shows the answer. a sharp uptick in gold prices. As interest rates crashed post the economic crisis in 2009, gold prices took off to new orbits. To put things in perspective, the rise in gold prices in rupee terms was 122% between 1994 and 2009. The same was 300% between 2010 and 2023. Being ahead of competition in terms of premium jewelry retailing allowed Titan to make the most of the sharp rise in gold prices. The Tata Group's credibility gave it significant edge in gold sourcing and supply chain as well. But is the edge here to stay? Can Titan continue to rely on gold prices and Tanishq to help the company fight stiff competition in jewelry retailing today? Mind you, even some small jewelry retailers are giving the company stiff competition as we speak. Over the past few decades, the stock of Titan created super investors like the late Rakesh Jhunjhunwala. The stock has been a 9-bagger in the past decade. So much so that it ended up being the jewel in the Tata crown. But it is important to note that the contribution from the gold business and the sharp spurt in gold prices have been instrumental in Titan's fortune. Question is, can the stock of Titan continue to deliver irrespective of the upside in gold? Also, does the business have enough steam to generate the earnings growth when the valuations are already steep? Well, Titan has manufacturing and assembly plants at Hosur, Coimbatore, Dehradun, Roorkee, Pantnagar, Karnataka and Sikkim. The business is currently structured into the 4 verticals of watches, jewelry, eyewear and others. Here, others includes aerospace and defense, automation solutions which is part of subsidiary TEL, fragrances, Indian dresswear and accessories. In other words, not only does the company have enough capacity to keep the business scalable, but is also reasonably diversified to suit different consumption trends. But the key source of earnings growth as well as profits has been only one, the gold jewelry business. Like I explained earlier, the company has enjoyed a healthy premium over peers due to its gold quality certification since early days. But in recent quarters, competition has started nibbling into Tanishq's profits. First of all, the premium charged by Tanishq on the gold price has declined by nearly 50% from historical levels. Plus, Tanishq is aggressively competing with retailers like Kalyan Jewellers, TBZ, Senco, GRT, Malabar Gold, etc. in top metro cities. Here is a comparison of the financials of Titan with its peer listed jewelers. As is evident here, while Titan sports significantly better return ratios as compared to its competitors, its valuations are also as much as 3 to 5 times that of the nearest competitors in the jewelry segment. With its competition having moved to one nation, one gold price, Tanishq may have to further fine-tune its pricing model. To add to that, the firmness in interest rates may leave very little headroom for upside in gold prices. But Titan does have other plans up its sleeves. These primarily pertain to expanding the scope of some of its new businesses. It plans to grow its ethnic wear business, which at present operates under the sari brand Taneria. The company is eyeing 125 stores by 2027 along with an omni-channel presence. It aims to achieve more than Rs 10 billion sales by targeting young sari wearing customers. Titan plans to expand the women's bags business under its popular watch brand Fast Track to Rs 10 billion by 2027. It aims to sell 3.5 million pieces of the same in this period. Now, one look at the list of subsidiaries of Titan will tell you that the company has a reasonable amount of intrinsic value waiting to surface. The watch and gold businesses of Titan may over time occupy lesser proportions of Titan's embedded value. But in the meanwhile, the company's ability to retain its premium valuations may continue to fluctuate wildly. This may be a case of extremes like in the case of the California forest fires or the Japanese indices. Please note this is not a view on the stock. Please do your due diligence carefully and consult your investment advisor before allocating to any stock. Hope you like this video. Thanks for watching.
Thank you for tuning into Equitymaster's YouTube channel. If you enjoyed this video, we've got many more valuable investing ideas for you. Click the link in the description to access them now.